Welcome to The Two-Handed Economist with John Diamond, where we look at issues from all the angles. President Truman once asked for a one-handed economist because he wanted someone to help make decisions and to not always say on the other hand. In this podcast, we try to look at every issue from multiple angles in order to reach the best solution to the problems at hand. Today is Tuesday, May 13th, and we got three big developments from this weekend to discuss. Trade deals with the UK and China were announced on Friday of last week and over the weekend. A major tax bill is making its way through the House and is currently in markup in the House Ways and Means Committee. And a new executive order was announced on Monday that could completely change how America pays for prescription drugs. Those are the topics we'll discuss this week, so let's just dig right in. Let's start with trade. This week, the U.S. announced trade deal frameworks for new agreements with both the United Kingdom and China, two very different trading partners, and the stakes of these agreements are also very different. The announcements have generated a lot of buzz and a lot of confusion, so let's discuss these deals in a little bit of detail. The trade deal between the U.S. and Britain is a bad deal. But stocks rallied after the discussion and after the details of the deal was announced. This mainly occurred because a bad deal is better than no deal. But why is a bad deal better than no deal? This is true even though tariffs reduce short and long-run growth, because the uncertainty related to the erratic and unpredictable nature of trade conflict is much worse than the negative impact from a stable tariff policy. In the midst of a trade conflict, businesses and consumers must prepare for all possible outcomes, including a complete breakdown of trade. Reducing that risk, at least for now, allows for markets to begin to act with more certainty. The terms of the deal between the U.S. and the U.K. are relatively unimportant to the U.S. given current trade flows and tariff rates. The two countries have close to balanced trade in terms of goods, and the UK accounts for roughly 3% of total U.S. trade. In addition, the trade-weighted tariff rate on U.S. exports was near zero, with the UK imposing a 0.5% tariff on U.S. goods. By comparison, the U.S. was imposing a 3.4% tariff on UK goods. However, the administration incorrectly claims that the UK tariff was 5.1%. That's not true. The rate was much lower at just over half a percentage point. These numbers imply that this deal is really insignificant from a U.S. perspective, except it does create some certainty and provides information about future deals with other countries. I think it's reasonable to expect that 10% is going to be the lowest or the baseline tariff rate, given that with the UK, we were running a trade surplus or very close to balanced trade in terms of goods trades. The primary economic takeaway from this deal is that it offers little economic upside for U.S. businesses. In fact, it's a net negative when all factors are considered. While it claims to open $5 billion in new market access, according to the White House, that figure reflects the total market value of exports, not actual profits. The true benefit to American firms will be far smaller, as they will roughly equal the profits that those firms accrue. And to some extent, the wages paid by firms to the extent that there's slack in the labor market. At the same time, the deal raises $6 billion in new external revenue by imposing a 10% tariff on goods imported into the U.S. But this is paid mostly by consumers in the form of higher prices and less choice, and by businesses in the form of higher input prices. In the context of total U.S. trade flows, the expansion of the U.K. markets to U.S. goods is relatively small. Yet it's being sold as a major breakthrough. Worse, the deal sets a precedent for future agreements. Because the U.S. ran a small trade surplus in goods with the UK in 2024, this deal effectively establishes a 10% minimum tariff floor for other countries. Any country that exports more to the U.S. than we export to them, that is, countries that we have a trade deficit with, will likely face higher tariffs, raising the risk of trade tensions in future agreement talks. Uncertainty is especially damaging for firms because it paralyzes decision-making at every level. Without knowing what rules apply, companies delay investments, stall hiring, and rethink supply chain commitments. Global firms depend on clear trade terms to plan, produce, price, and organize their logistic strategies. Uncertainty throws all of that into flux. It also raises the cost of capital as lenders and investors demand a higher risk premium when the future looks murky. So by comparison, a bad trade deal provides clarity. Firms know the cost, they can plan around them, and they can avoid the worst-case scenarios. That's why for many businesses, a flawed agreement is better than dragging out negotiations with no resolution in sight. We've seen the same more recently with China. Again, we can frame the Chinese agreement in two ways. We can look at the reduction in tariff rates from 145% down to 30% for the tariff rate on goods imported into the U.S., and from 125% down to 10% for goods exported from the U.S. to China. While those are significant reductions, we can look at it either in terms of how much better are we off this week compared to last week, which we can say we're much better off, or we can look at it as how much better off are we today than we were, say, January 1st of 2025. And in that case, we would say we're much worse off today than we were at the beginning of January. So the time frame we're looking at makes it really important in terms of, did we just win or did we just lose in this trade battle? In the end, there are no winners in trade wars, just losers. What we can see from the latest deal with China is that there will be no decoupling from China, as was often stated as a reason for this trade war. And it's unlikely that the international system for trade and finance is going to change much either, given that we're moving back to a world with relatively low tariffs, at least relative to 145%. Granted, a 30% tariff is still very high when compared with what was in place January 1st of 2025. Now let's turn to taxes. This week, the House Ways and Means Committee is marking up what Republicans are calling the One Big Beautiful Bill. Essentially, it's an expansion of the Tax Cut and Jobs Act, plus a lot of campaign promises from the president. The bill would make expiring provisions permanent, or at least some of them, and it would add in several flashy campaign promises, such as no tax on tips, overtime, or Social Security. But the problem is it's not fiscally sustainable. What's being marked up in the House will expand the debt by roughly $2 trillion over a decade. Starting from a $36 trillion debt and a $2 trillion deficit each year, we can hardly afford a tax bill that adds $2 trillion to the existing debt. And that assumes that there are significant cuts in expenditures. The framework in the House was to reduce total taxes by about $4.5 trillion over a decade, and at the same time to reduce expenditures by $2 trillion over a decade, leaving a net increase in the debt over a decade equal to $2.5 trillion. The specifics of the deal are still being worked out. The bill does some good things. For instance, it expands expensing of investment expenditures. In addition, it exempts research and development expenditures from being expensed. Those are good things. Unfortunately, the bill only does it for a 4-year period from 2025 through 2029. The bill makes all of the rate cuts under TCJA permanent, and it also makes the increase in the standard deduction permanent. Those are positives as they provide more certainty to taxpayers about the future of the tax structure. Yet there are many provisions that are short-term in nature that expire quickly, such as to accomplish the no tax on Social Security, the bill just has a additional $4,000 standard deduction for seniors, which expires at the end of 2028. And it phases out for income levels of $75,000 for singles and $150,000 for married couples. This is just adding additional complexity to the tax code. The bill also passes some tax policies that aren't so great, such as it implements a no tax on car loan interest, which will run through 2028. It raises the SALT cap to $30K from the current cap of $10K, with the SALT being the cap on state and local taxes. It increases the child tax credit by $500 and indexes it for inflation, but it only does so for 2025 to 2028. And it extends and increases the pass-through business deduction, called Section 199A, and makes it permanent. It increases it from 20% to 22%. Those are just a few of the provisions included in the bill. There are far too many to sit here and go through each in this discussion. But let's just say this is a massive bill with many policy changes, some that are reasonable tax policy changes, some that are not. Should we really not tax tips, overtime, or Social Security benefits? Is that really efficient tax policy? As the bill continues to move through the House, we can have more detailed discussions about the good, the bad, and the ugly in this bill. But let's just leave it for now, as this is a really big swing. Supporters say it's about stability, fairness, and making the economy grow again. Opponents say it's fiscally reckless. One thing is certain, as we get closer to the midterm elections, many of these issues will be important on the campaign trail. And finally, yesterday morning, President Trump signed an executive order introducing a most favored nations policy for prescription drug prices, aiming to tie what the U.S. pays to the lowest price paid by any other developed country. It's a dramatic shift, and it's one that's been floated in the past, but never implemented at this scale. So let's talk about what this means. This policy aims to reduce spending of U.S. consumers on prescription drugs. So let's talk about the pricing of pharmaceutical goods for a minute. There are really two types of pharmaceutical goods: generics and non-generics. Generics are normally low-priced goods, and non-generics or brand names are normally high-priced goods. So if you look at total expenditures by U.S. consumers, about 80% of total expenditures are on brand name drugs, and about 20% are on generic drugs. And that's because the brand name drugs usually have very high prices, where generic drugs are usually fairly low in price. If we change our lens and instead look at the number of purchases, so the number of transactions, you'll see that generic drugs are about 90% of the number of transactions or purchases, and brand name drugs are around 10%. These are rough data. So this shows that while there's a lot of generic transactions, 10 to 11% of these brand names are really high value transactions. Expenditures are exactly the opposite, with 80% being spent on brand name and around 20% on generics. So why does this happen? The standard story is that to create a drug is really expensive. And there's a policy in the U.S. when a pharmaceutical company produces a new drug, it gets to patent that drug, which means it gets to be the sole provider of that drug for some period of time, usually around 17 years. During that period, the firm owns essentially a monopoly. No one else can produce the drug, and so there's no competition in the production and sale of that drug, which means the producer can sell the drug at really high prices in an effort to recoup all of the cost, all of the research and development cost of coming up with this new drug. So the reason for the patent is that if you didn't allow companies to recoup these investment costs, The fear is that the companies would never produce these new drugs and innovation would dry up and we would all be worse off. And so we go through this period where the companies produce a new drug. They have the right to be the only seller of this product over this extended period, which gives them a chance to recoup all of the research and development costs related to this new drug that makes society better off. So under the president's policy, this would no longer be allowed. And I just want to point out that for generics, there's not going to be an issue with the U.S. paying significantly more than some foreign country. That will only be the case for these newest high-priced drugs. And because we essentially allow these companies to have a monopoly, we say if you produce this, you get the patent, you can be the only firm that produces it. One thing that monopolies do is they try to maximize profits, and they do that by reducing output and raising price. Another way they maximize profits is by using something called price discrimination, which is where you charge different consumers different prices based on some characteristic. So in the drug market, pharmaceutical companies will price discriminate across countries, and they will charge high-income countries more than they charge low-income countries. And so we do end up with significant disparities in the prices, say, that are charged to the U.S. versus, say, Serbia or some country that has much lower income than the U.S. The fear is that by imposing a most favored nations policy and requiring that all prices be equal, that will reduce the profits of the pharmaceutical companies. It'll lead to them being able to recoup less of the research and development cost, and it may hamper or reduce innovation in the long run. Now, is that true? I don't have all those numbers at hand, but that's what's underlying this policy. On the one hand, there's a fairness issue. Should different countries be charged different prices? And on the other hand, there's an issue of, if we implemented a single price, would pharmaceutical companies still invent and innovate and produce as many of these new drugs that make us all better off as we would without this policy? And that's the trade-off. And I think that's what really needs to be considered before we do something like this in too quick of a manner. So to sum up, if this policy was implemented, it could lower the cost. It could also reduce innovation and the number of new drugs we see coming to the market. And that's a trade-off that needs much more research and much more discussion than we've been able to give it in this short time. That's a topic that there's much more to discuss than we're going to cover here. But that's the basics of what's going on with this policy. So we've covered a lot of ground today. Here's the upshot. The U.S. is making diplomatic moves on trade. The real question is, has the trade war made us any better off over the last 3 months? Have we accomplished anything by enacting absurd levels of reciprocal tariffs on everyone in the world, only to now start removing them with trade deals that return us to basically what the president said he wanted on the campaign trail, which was a minimum 10% tariff on everyone and a slightly higher tariff on China? And that just begs the question, what have we done since February? Why didn't we just go directly to a 10% broad tariff? Although I will note I don't support the 10% tariff either. I think that's a bad deal for Americans as well. In addition, the tax fight is heating up, and it's heating up big time. The one big beautiful bill, well, it's definitely big, and it'll definitely reshape the post-TCJA landscape. We'll see if Congress actually is able to pass this bill as we go through the process of the bill, both in the House and the Senate over the upcoming month. And finally, the White House just threw down the gauntlet on pharmaceutical pricing, triggering what could be a major policy and legal battle. We'll be tracking this as we see it progress over the coming weeks. The Two-Handed Economist is produced by the Baker Institute for Public Policy at Rice University in Houston, Texas. Production support was provided by Karina Zamel, Shannon Moriarty, and Kevin Young. Be sure to visit us at bakerinstitute.org for more, and thank you for listening.